Hmm.
Hello, Sean.
Morning, Dan.
How are you? Can you hear me okay?
Yeah.
All right. I guess I have to get my slides up.
Yes.
Hmm. Yeah, I'm going to try and share. Can you see something?
Yep.
All right. Put on slideshow and see if this all works. And going up and down works.
Yes.
So I think we're there. Let me just get the chat open.
Hmm.
Okay. I am good to go as far as I can tell.
Okay. So about 5 minutes, I guess.
Yeah,
All right.
at your convenience.
All right.
Yeah. Oh, okay. Um, hmm. This is one, I just don't see it. Yeah, well, fine, you can deal with all these. Nothing to do with it. It just doesn't make it. Well, that was the motivation. Yeah. I'm not. Huh. Three banks. Oh, that's a good question. Service code. No, there's one in South Willow. Okay, where all the other banks are. Okay. Yeah. If you stop, what would you? I think you're excited. I'm not excited. Yeah. There's any, well, maybe there's nothing there that I can say. You can do whatever. Oh,
Hmm.
okay. I believe.
Are you all set to go?
Yeah, think so.
Are you in a different location?
Yeah, I'm in New Hampshire today.
Okay. You sound kind of like, I don't know, echoey, not echoey, like maybe a little further away from the mic as usual. Like, I don't know. You're on the,
I don't think so. It may just be that my Vermont house is very isolated, so there's no background noise. Right now, I'm in a city.
okay. All right. Are you all set?
Yeah, is this okay? I'll move the computer a little closer to me.
Yeah. I mean, you sound okay. It's just you don't, it's fine. It's just maybe like a little slightly echoey than usual.
Yeah, it may just be that, the Vermont house has more carpeting or something.
Okay. I'm going to end the practice session and start. Okay.
Okay, I'm ready to go whenever you are.
All right. Hello. Welcome to Northfield's December mid-month research webinar. I'm Sean Ledger. I'll be the host today. In a minute, we'll hear from Northfield President Dan Bartolomeo, who will be presenting a general formalization of risk on, risk off. Before I hand it over to Dan, I want to remind you how our webinar works. If you have any questions today, please post them to the chat box on the right side of the screen. If Dan doesn't get to all your questions, he'll answer them personally after the event with the email address you registered with. If you have any issues with the internet audio stream, please call into the conference call. Conference call information will be posted in the chat box. Also, a recording of the presentation and the slide deck will be sent to everyone who registered for this webinar today, which we hope you'll forward along to your colleagues. Okay, now I'd like to introduce Dan Bartolomeo. Dan?
Thank you, Sean. Good morning to those of you in the Americas. Good afternoon to those of you in Europe and the Middle East. For those in Asia or Australia, I suggest you go back to bed and watch the recording, which will be distributed in a couple hours. Today's topic is the issue, what I'll call the topic of risk on, risk off. And this phrase has been, something that has become very much a staple of financial reporting. Pretty much every decision that large investors sort of make is now being attributed in some way to this concept of risk on and risk off. I'm going to define it in some way, which is to say that it's a practice by institutional investors to increase or decrease the level of risk in their portfolios, depending on whether they believe financial market conditions will be favorable to the particular strategy that they're pursuing. This sounds a lot like old concepts like market timing and tactical asset allocation. But I think the difference is that, at least at a conceptual level, those concepts, those strategies were really about forecasting returns, whereas risk on, risk off seems to be about risk levels and levels of uncertainty about what's going to be happening next. Not so much that investors have a definitive idea that the market's going to go up or down. Now, the concept of reducing or increasing risk obviously can mean lots of different things to lots of different investors, depending on the type of portfolio you have. For an equity portfolio, it might mean adding to or reducing market beta, switching between large cap and small cap, between developed and emerging markets. For a fixed income investor, it might have to do with how much credit risk there is in the portfolio, or how long the maturity of the portfolio is, how much interest rate exposure it has. And for a multi-asset class investor, it's really typically about shifting asset mixes. Are we going to move to more than the usual amount of equities or less than the usual amount of equities? Um, so it can mean a lot of different things to lots of different people. Um, uh, Today, what I'm going to try and do is really just give you a mathematical framework that you can use to formalize these kinds of decisions. And the presumption is that an investor will make this kind of decision, risk on, risk off, if they believe that somehow market conditions have changed sufficiently. And I'm just going to refer to that as a regime change, that the world is somehow different than it was recently. um, you're going to see parts of the mathematics relate to a couple of prior papers that have been extensively discussed and covered in prior webinars. We didn't make all this up from scratch. The other thing that I think is a little different about these processes is that they seem to be driven by risk, not return forecasts. And therefore, we're going to formulate the problem in a particular way. These kind of strategies are often implemented with the use of derivatives like stock index contracts, credit default swaps, all sorts of things, not actually trading the underlying securities in order to minimize transaction costs. And I'm going to hopefully show you that transaction costs are influential in this and should be very carefully considered. Um, the other thing I'm going to do is toward the end of the presentation, I'm going to describe a couple ideas about parameterizing some of the key inputs here. So let's talk about the basic framework that we want to try and follow. The first is that the investor has already defined two different portfolios, either of which they are willing to hold under various market conditions. One of these portfolios has higher return and higher risk expectations for the long run, and I'm going to call that risk on. And the other portfolio has long-term expectations of a lower return, lower risk, and I'm going to call that risk off. In a classic market timing strategy, risk on would be a full equity portfolio and risk off would be cash. Now, under typical conditions, most of the time, the presumption of the framework is that the investor chooses one of the two portfolios to hold most of the time, and that portfolio is consistent with their level of particular risk aversion. Now, when conditions change, the investor obviously has the ability and the willingness to switch to the other portfolio, which they believe will provide them with a higher level of utility for some temporary period of time. So there is kind of a habitat concept here that the investor typically will be in risk on or typically be in risk off, but is willing to switch temporarily to the other when conditions dictate. So let me just sort of state this in very simple math. The investor is predominantly going to hold one of the portfolios, may switch. I'm going to use standard, textbook utility function, where the annualized expected utility can really just be thought of as a mean variance risk-adjusted return. That, of course, comes from Markowitz and Levy in a 1979 paper, almost 2 decades after Markowitz's earlier papers on the efficient frontier. The utility value is just the risk-adjusted return. We have an expected return. We have an expected volatility. And I'm going to mention very carefully that volatility number, which we square in order to get a variance, is going to be adjusted for the existence of higher moments. Lots of strategies, think of a high yield bond portfolio, something like that, do not have normal distributions in expectation. And so we're going to adjust the value of the sigma, the expected value of volatility for these higher moments. This is something I've talked about in webinars many, many times. I'm then going to scale the variance by what we refer to as a risk acceptance parameter. You can think of this as just 1 over lambda in the classic Markowitz framework. And I've written out the two equations for the two portfolios, one being risk on, one being risk off. There is a question from the audience about what is RAP beyond saying it's an adjustment to the RAP is not the adjustment. The adjustment to the magnitude of sigma is done separately. The RAP value is simply an indication of where the investor wants to be on the efficient frontier. If you think about an efficient frontier, you can be down at the conservative end, very close to cash, where you have low return, low risk, or you could be at the high end of the efficient frontier with a higher return expectation and a higher risk. RAP is simply the reciprocal of the slope of the tangent line. So how we define where we are on the efficient frontier is to draw a line tangent to a particular point. And RAP is simply the reciprocal of that tangent. I like to put the RAP value in the denominator simply because it precludes the possibility of having a zero there. An investor who was entirely willing to take no risk at all under any circumstances. And because if they did, they would just be holding cash forever, and that would make the whole thing very uninteresting. Now we need to figure out, or at least estimate, what an appropriate slope, what an appropriate tangency slope is for a particular investor. And we're going to do that by an inference from the volatility of the portfolio they're choosing to hold. Obviously, if an investor is more aggressive, they'll hold a high volatility portfolio. If they're more conservative, they're going to hold a low volatility portfolio. And so we're going to estimate this RAP value, this reciprocal of the tangency slope, as 6 times the volatility of the investor's chosen portfolio, inclusive of all of the adjustments for higher moments. The reason we get to the number 6 is that RAP has a scale from 0 to 200. And if you think about maybe a 3 standard deviation event being the extreme values of the expected return distribution, you can do a little bit of algebra and it will come out that the RAP value would be roughly 6. There are a bunch of papers that justify that rationale. One is one I published in 2021. There's an earlier and much more profound paper by Jared Wilcox that was in Journal of Portfolio Management in 2003. And some of the idea goes all the way back to an early paper by Litzenberger and Rubenstein in Journal of Finance in 1976. And I've also done a webinar to explain how we got the six number. Uh, and one of the nice things about the sort of six rule of thumb is that you can think about downside. You can think about investment losses as being defined in absolute terms. You lose money, benchmark relative, where you underperform a benchmark, or some weighted combination of the two. Now, risk on, risk off strategies are usually talked about in absolute return terms, but there's no requirement that that be the case. There's a brief reference to a paper by George Chow that appeared in Financial Analyst Journal in 1995 that talks about the idea of having essentially a three-term utility function where we have return, absolute risk, and benchmark relative risk all in one formula. It turns out you don't need that because since the benchmark and cash, which would be essentially the benchmark for absolute returns, have no covariance, you can collapse the whole thing back to two terms anyway. It just means that the benchmark is a weighted combination of whatever index benchmark you have and cash. So now we're going to do a quick substitution. I'm going to assume that the investor is risk on most of the time, because most of the time when people switch, they refer to it as de-risking. So I'm going to make the inference that most people think of risk on as their usual portfolio. And obviously what we're trying to do here is we're going to allow the investor to switch between the two portfolios, the high risk, high return portfolio and the low risk, low return portfolio, net of transaction costs. And under the assumption initially that the revised parameters were a permanent change. If the world has gotten riskier or the world has gotten less risky, at least initially, we don't know how long that new regime, that new set of conditions is going to last. So all I've done here is, under the assumption that we have a risk-on investor, I've taken my wrap value, which becomes 6 times volatility. The numerator of the risk term is sigma squared. You cancel the sigmas and you're left with sigma over 6. I can't quite do that in the second equation for risk off, because my risk term is now risk off, where my wrap is based on risk on, because that's where the investor spends the predominant amount of time. But we still have two equations that we can readily parameterize. And obviously what we would like to do is have the investor switch between whichever one has a sufficiently high utility to make the switch worthwhile, given any transaction costs that would be involved in making the switch. So let's talk about the time element a little bit. Oops. Now, if an investor believes that the market conditions have changed, so the expected returns are different, the sigmas are different, they also need to decide if the change is temporary or permanent. Now, if it's permanent, then always switching to the higher utility portfolio is going to be the correct thing to do, even in the presence of transaction costs. By the end of time, the end of infinite time, any benefit will eventually accumulate to be larger than the transaction costs. Now, if we're dealing with a finite horizon, like we think conditions have changed, but they may only stay that way for a week or a month, now we have a different problem, because we have to decide what is the likelihood that switching portfolios will actually benefit us in the time horizon in this next period, this next week, this next month, whatever it is. Now, the likelihood that the higher utility portfolio will actually perform better in the next period is going to be better than 50%, but less than 100%. It is always possible that the higher utility portfolio will realize a worse result just out of random sample error over some finite period. And so what we need to do is to decide how confident we are that the higher utility portfolio will actually produce a better result. And obviously, we want to consider transaction costs as well. Now, we know, because I've got my two equations for the two portfolios and their respective utilities, what the difference in utility is given a set of inputs. And the confidence interval on that difference in utility is actually the tracking error between the two portfolios. And so I can calculate something like a t-stat to decide, given the time that I'm going to allow, whether it's a week, a month, however long I think the new conditions are going to persist, I can determine the probability that the higher utility portfolio will actually produce a better outcome. And I'm going to use that in deciding whether or not it's worth to expend the trading costs or not. This is something I've given multiple webinars in the past, and I've given you a link to a working paper on our website that has more of the details. Now, if we're going to think about this idea of risk on, risk off as usually de-risking, right? We're going to assert that the choice of switching portfolios, yeah, I see somebody in the audience is correcting a typo for me, and that's probably true, and it's yeah, you could rewrite it that way, fine. Yes, you could, yeah, you could rewrite the equation that way, but the key thing is that the choice of switching portfolios is motivated by one of two beliefs. Either the risk levels have gone up a lot, right? And so investors believe risks are greater than they typically are, or the investor has expectations for returns being temporarily below the long-term expectation, but that they have low confidence in that return forecast. So either the risk levels are up or return expectations are down, but we're not very confident in those low return expectations. I would make the semantic argument that if investors just thought there were going to be negative returns, let's say the stock market's going to go down, they would describe that view as something other than the risk on, risk off terminology. They would use bearish view or have some numerical explicit forecast of negative returns in order to justify what they're doing, as opposed to using the risk on, risk off terminology. I think a reasonable way to summarize what motivates people to go to a risk off condition is to say that the investor has the expectation that large magnitude negative return outcomes were more likely than large magnitude positive return outcomes for the more aggressive portfolio. And so if I'm typically in the aggressive portfolio and I say, well, under the current conditions, I think there's a lot more downside than upside in the tails, then that's may be why I want to switch to the risk off posture. However, if that's the logic, then the expectation of the distribution of returns would have negative skew and positive excess kurtosis. So again, here is where we have to think about this idea that the expectation of future returns is not normally distributed. Hmm. Hmm. Um, Hang on, something got stuck. There we go. All right, so now I just want to talk a little bit about this idea that when we have expectations for returns, for the distribution of returns, that are non-normal, uh, we can create what I would call a volatility equivalent value. And this allows us to keep the logic of a mean variance utility function. It allows us to use traditional statistical tests like t-stats. We just have to adjust the volatility value in the appropriate way. Um, the most common way of doing that uses a quantile method. It goes back to an old paper by the economist Irving Fisher in 1938. The mathematical procedure is something called an Edgeworth expansion. It involves affine polynomials, which is something similar to the argument for the basis of a Taylor series. I wrote a paper which was published in 2023, actually two papers in 2023, one in Journal of Performance Measurement, one in Journal of Portfolio Management for 2023 with all of the mathematical details and examples. So it's pretty straightforward. We're going to take this process that we're involved with. We're going to try and estimate it as a four-moment distribution. That is mean, standard deviation, skew, and kurtosis. And then we're going to use the Cornish-Fisher method to essentially adjust the standard deviation value to essentially incorporate the skew and the kurtosis. We're essentially taking the skew and kurtosis values and stuffing them into the volatility in an appropriate way. And obviously, you would think that negative skew and positive excess kurtosis would both be increases to the volatility. I also did a webinar, actually a couple of them, about explicitly converting tail event probabilities. So if you think about risk on, risk off as being motivated by large upside events are less likely than large downside events. In the particular webinar that is linked here, there's a discussion of that. Actually, it's a discussion of the opposite, where we're actually picking a stock or picking a security that we think is going to have more upside than downside. But the algebra of the conversion should be pretty obvious. So again, what we're doing is thinking about tail probabilities, and we're eventually just going to end up with an adjusted value for the sigma. So now we know that this whole thing is motivated, the switching from risk on to risk off or risk off to risk on has to do with revisions in sigma. The fact that the sigmas, after adjustment for higher moments, are now larger or more different or smaller or something than they were before. And that is what we're calling the regime change, which is what motivates this particular process. Now, I'm going to use the algebra that would be appropriate if risk on is our normal position, but the algebra works exactly the same way the other way. And what I'm going to do is I'm going to estimate the change in sigma off, that is the risk of the low risk portfolio, conditional on the revised value of the high risk portfolio. So if I believe markets are getting more volatile, or conditions are such that risks are greater, it is likely that that will affect both the high risk portfolio and the low risk portfolio. Um, and a couple of slides ago, we did use the tracking error between the two portfolios as part of the decision of how to allocate transaction costs. I'm going to use it again here just as part of the algebra, one, to compute the beta of the risk off portfolio to the risk on portfolio, or to its benchmark. And then I'm going to compute in the second equation the revised or updated value for sigma off, conditional on a new value for sigma on. And the algebra just works out to be what I've described there. Essentially, I'm assuming that the idiosyncratic risk that is embedded within sigma off stays the same, and that all the changes in sigma off are motivated by the market conditions that are causing us to change our forecast for sigma on. So the last sort of important piece to this process is the question of time horizon. As I said before, if transaction costs are non-zero, we have to consider those costs in terms of whether it's likely that switching portfolios in terms of utility will be large enough over some finite interval to offset the transaction costs. We know that if it's a finite interval, we're not guaranteed of actually producing a better outcome. We have to decide what that better outcome is, and over a particular time period. Now, the way I choose to do this, and this is not the only way to do it, is to basically say, if I think risks have gone up, the expectation would be that the value of risky financial assets would decline. So if you think about a dividend discount model, capital asset pricing model, any sort of traditional asset pricing model, if the risk gets higher, risky assets are worth less. Now, interestingly, what we tend to observe in markets almost uniformly is that when asset prices increase or decrease because of, or at least apparently because of, an increase in risk, that asset price decline is smaller than would seem justified if investors believed that the increased risk level was permanent, right? I've got a paper that I published in 2020 where we have a computational example of this. Essentially, in that particular case, at the beginning of COVID, we estimated that using VIX as a measure of stock market volatility, that the risk was about 4 times normal in sort of early 2020. You may remember that the VIX was trading at around 60, and maybe 15 or 16 or 17 is a more typical value. If you take that information into something like a dividend discount model and assume that the change was permanent, what we should have observed was that the stock market, as measured by the S&P 500, which is what the VIX addresses, should have gone down by about half. It didn't. It went down somewhere between 25 and 30% during that period. Now, because the decline was lower than the decline was smaller than would be justified by the increased risk, if that increased risk was permanent, the only way to get those two sort of stylized facts to match is to assume that the increase in risk is presumptively temporary. And you can do the algebra backwards, in effect, to solve for the amount of time you believe, or at least based on the VIX value and the market action, you can infer what time interval would be required before financial market risk went back to normal. And in the 2020 paper, which was written in March of 2020 and published almost immediately, the calculation came out that things would go back to normal in about 6 or 7 months, which would have put a return to financial market normalcy, if not life in general normalcy, somewhere in the fall of 2020, which was about right. By late October 2020, the VIX values were back to their normal sort of teens level. The other thing that we should talk about, at least briefly, is that while everybody talks about risk on, risk off, in a sort of binary fashion, you've got two portfolios that you are okay with, and you're going to either be in one or the other. There's nothing sort of theoretical as to why this process couldn't be continuous, where the investor is just making small changes in their portfolio, sort of moving little by little between risk on and risk off, in response to changes in market conditions. Now, there's a long history of ideas like that. The most famous one, of course, being constant proportion portfolio insurance. That idea was really first formalized in a paper by Fisher Black and Andre Perrault in '92. Interestingly enough, of course, this is after the 1989 market crash, where lots of people blamed portfolio insurance strategies as causing the crash. Now, the idea of portfolio insurance is consistent with the concept that is called GLUM, which is generalized logarithmic utility model. This is from the Litzenberger and Rubenstein paper that I mentioned earlier. And the basic idea is that investors are risk averse, including skew and kurtosis. And they try to floor the value of their portfolio in a particular procedural way, which is what CPPI actually embodies. Now, one really simple idea you could do, and there are certainly asset management firms that do this, is to simply make these changes incrementally. But the idea would be that if you're a long-term investor, you might want to just keep your portfolio risk constant. If the market risk increases, you move to a slightly less volatile portfolio. You reduce aggressiveness. If the markets get very quiet, you increase aggressiveness so that the level of your portfolio risk remains constant through time. And that is consistent with the idea of constant proportion portfolio insurance, or the Rubenstein-Glum concept, for the special case of an investor with no liabilities. So if you thought about maybe a sovereign wealth fund or some individual who was incredibly rich and for whom the concept of liabilities was de minimis, then you could just keep your portfolio risk constant and still get the theoretical benefits of GLUM and portfolio insurance. Now, in the real world, most asset owners, most large investors do have liabilities, pension funds, insurance companies, and so forth. So that's not quite the right fit in terms of concept. The other thing we should think about in terms of risk on, risk off is, how do we know if it worked? And the easy way to do that is to evaluate it using a simple time series regression. The one that has been sort of the standard for now almost 60 years was published by Trainer and Mazoy in Harvard Business Review in 1966. If I assume that risk on is the predominant position, that is, we go to risk off when we need to, then I can just take my actual portfolio returns over time. I estimate this regression equation. We've already calculated what we think B should be, and we might get a slightly different value out of this because now we're mixing the periods of time when we're risk on and periods of time when we're risk off. It's not quite the same B. I'll maybe change the notation a little bit when we send the slides around. But what you should see that's important is that A should be positive. That is essentially your skill level at selecting securities. But more importantly, for today's discussion, what we really care about is that the C is the C coefficient is both positive and statistically significant. Two questions from the audience. One is I've framed this problem as two portfolios, a risk-on portfolio and a risk-off portfolio. And the question from the audience is, could I think about this as being sort of a case where the risk-on and risk-off portfolios are the same, but I add in some external portfolios that act as diversifiers? The answer to that is yes. I have to think about the idea of how you finance that in terms of leverage, because if I've got one portfolio and I want to add something to it, I have to, in effect, if I'm going to do it with real securities, take out a margin loan, or I could do it with derivatives and create the leverage implicitly. But yeah, you'd have to rewrite some of the algebra to incorporate the leverage effects, basically. The other question from the audience is, what is the M of the last term? It's the return on the benchmark for the risk-on portfolio, which could be the risk-on portfolio itself if you only care about absolute return. If you have an index benchmark, then you're going to use that for this particular case. It's not a 2, it's a squared. So what I'm really trying to do is I'm trying to, through the C coefficient, determine if my returns are positive when are relative positive when the returns on the risk on benchmark are a large magnitude. And by squaring it, obviously, we focus large magnitude events. So just to wrap up for the day, what I've tried to do is present a computational framework for this idea of risk on, risk off, where investors are typically holding a risky portfolio and switch to a lower risk portfolio that they call de-risking when they deem appropriate. Unlike the way I think about market timing or tactical asset allocation, the focus here is a lot more about perceived risk and perceived uncertainty than it is about I'm confident the market's going to go up or down, and therefore I'm going to make a change in my portfolio. The one thing that allows this to sort of work smoothly is this idea of an inference about the investor's risk tolerance. I'm not going to the investor and saying, what is your tangency slope on the Markowitz efficient frontier? I think most investors can't answer that if you did ask them. But there is a way to infer it from their habitat, what portfolio they typically choose to hold. We tried to address the fact that risk on, risk off is clearly transient. It is temporal. Everything about it is presumed temporary. And the way we're going to do that is think about this idea that when we have a temporary circumstance, something over a finite interval, a better portfolio is not guaranteed to produce a better outcome ex post. The better portfolio in expectation may still produce an inferior outcome. And so we want to be very careful about how we choose to address transaction costs. If it were free to switch back and forth, it'd be a lot easier because we could just switch as often as we wanted. But if transaction costs are non-zero, we really have to put a lot of thought into this issue of if things are going to change, and therefore I want to change my portfolio, I have to think about what is the cost of that change and also how long I expect the new portfolio or the new conditions to persist so that I can garner some benefit from that. And we've talked a little bit about a couple of the critical inputs. We've talked about adjusting risk and uncertainty for different ways of thinking about risk and uncertainty. The idea that you can be thinking about tail events, you can be thinking about generally increased volatility, you can be thinking about generally increased uncertainty. And again, we've provided the algebra of how to make those adjustments for higher moments if in fact they are there. And also, last but not least, this idea that whatever happens in a risk on, risk off environment, we have to somehow parameterize how long we expect the new set of conditions to persist. So I'll stop there. I think I'm caught up on questions, so I'll turn things back to Sean.
Thank you, Dan, and thank you to everyone here for spending your time with us today. Just a reminder, the recording of the presentation and the slides will be sent out to all the participants later today. If there are any last-minute questions, or if you'd like to be contacted by someone here at Northfield, we'll leave the webinar open for a couple of minutes, and you can leave your requests in the chat box, and we'll follow up. Thank you for attending. Have a great day.